from investors.
Okay.
JMC could issue bonds to raise capital for that new factory, paying investors a fixed interest rate
Okay.
over a set period.
So instead of going to the bank,
Right.
JMC goes directly to the public for a loan.
Exactly.
What are the advantages of issuing bonds
Okay.
compared to taking out a traditional loan?
Well, one potential advantage is that companies can sometimes secure more favorable interest rates by issuing bonds directly to investors,
Okay.
especially if they have a strong credit rating.
Okay.
Bonds also offer investors a fixed income stream,
Okay.
making them a popular choice for those seeking stable returns.
So it can be a win-win
It can be.
for both the company and the investors. But bonds must come with their own set of risks, right?
Of course.
I mean, what happens if JMC can't repay its bondholders?
That's a crucial point.
Yeah.
If a company fails to make its interest payments or repay the principal on its bonds, it can default,
Okay.
which can have serious consequences.
Okay.
Bondholders rank higher than stockholders in the event of a bankruptcy,
Okay.
meaning they're more likely to recoup some of their investment.
Okay.
However, defaults can still lead to substantial losses for bondholders.
So it sounds like bond investors need to carefully consider the risks,
Absolutely.
just like stock investors.
Right.
What are some key things to look at
Okay.
when evaluating a bond?
There are several factors to consider,
Okay.
including the bond's maturity date,
Okay.
which is when the principal must be repaid,
Okay.
and the coupon rate,
Okay.
which is the fixed interest rate the bond pays.
Got it.
Another important factor is the bond's rating,
Okay.
which reflects its creditworthiness, or the likelihood that the issuer will be able to meet its debt obligations.
So just like with the term loan,
Yes.
the interest rate on a bond reflects the perceived risk
Right.
of the issuer.
Correct.
In this case, JMC. The
Exactly.
higher the risk,
Yep.
the higher the interest rate investors will demand.
Exactly.
Now, the book gets into some pretty technical bond terminology,
Okay.
like yield to maturity and interest rate sensitivity.
Right.
Can you break those down for us?
Absolutely. Yield to maturity, or YTM,
Okay.
is the total return an investor can expect to receive if they hold the bond until maturity.
Okay.
It takes into account both the coupon payments
Hmm.
and any capital gain or loss from buying the bond at a discount or premium to its face value.
So it's a way to measure the overall profitability
Exactly.
of holding a bond to maturity, factoring in both the interest payments
Yes.
and any potential price fluctuations.
Exactly.
Okay, what about interest rate sensitivity?
So that refers to how much a bond's price will fluctuate in response to changes in prevailing interest rates. Generally, bonds with longer maturities are more sensitive to interest rate changes
Right.
because they lock in an interest rate for a longer period.
Right.
If interest rates rise, the value of existing bonds with lower coupon rates tends to fall.
Ah, so if I buy a bond with a 5% coupon rate
Right.
and interest rates suddenly jump to 6%,
Yeah.
my bond becomes less attractive.
Exactly.
It makes sense that its market value would decline
Right.
because investors can now buy new bonds with a higher yield.
Exactly. They can get a better return elsewhere.
It seems like bonds can be just as complex as stocks
They can be out.
with their own set of risks and rewards.
Absolutely.
Yeah.
But they play a crucial role in the financial system,
Okay.
providing companies with an alternative way to raise capital
Mm-hmm.
and offering investors a fixed income stream.
Now, are you ready to dive even deeper
Oh, yeah?
into the world of business and finance?
Always.
What else does this book have in store for us?
Well, we're about to enter the realm of advanced business and finance,
Okay.
exploring concepts like bankruptcy,
Ooh, scary.
convertible bonds, and preferred stock.
Okay.
Get ready to expand your financial vocabulary and gain a deeper understanding of the complexities of the market.
Okay, so we're getting into some advanced concepts now.
Yeah.
The book delves into bankruptcy,
Okay.
which can be a pretty daunting topic, I think, for businesses and investors alike.
Yeah, for sure.
What exactly happens when a company can't pay its debts?
So bankruptcy is a legal process
Okay.
that allows companies struggling with overwhelming debt
Okay.
to either restructure their finances and operations or liquidate assets to pay off creditors.
So it's a way for companies to either get a second chance
Yep.
or make a clean break,
Right.
depending on circumstances.
Exactly.
What are the key differences between those two paths, reorganization and liquidation?
So in a reorganization,
Right.
the company works with its creditors to develop a plan for restructuring its debt and operations.
Oh,
This might involve renegotiating payment terms,
okay.
reducing debt obligations, or even selling off parts of the business.
Mm-hmm.
The goal is to emerge from bankruptcy as a viable entity.
So it's like hitting the reset button,
Yeah,
but it probably comes with some tough compromises.
it definitely can, yeah.
What about liquidation? Is that a last resort?
Liquidation is a more drastic measure,
Yep.
often pursued when reorganization isn't feasible.
Okay.
In this scenario, the company's assets are sold off to generate cash,
Okay.
which is then used to pay off creditors according to a strict priority.
It sounds like understanding this priority is crucial for investors.
It is.
Who gets paid first if a company goes belly up?
That's right.
Yeah.
Debt holders have a higher claim than equity holders.
Okay.
Secured creditors, those who have collateral backing their loans,
Mm-hmm.
are at the top of the list.
Yeah.
Then come unsecured creditors, followed by bondholders.
Okay.
Stockholders are typically the last to receive any proceeds from a liquidation,
Right.
and often they end up with nothing.
So if I'm an investor,
Yeah.
understanding where I stand in this hierarchy is crucial for assessing risk.
Absolutely.
Now, the book also introduces convertible bonds,
Okay.
which sound like a fascinating hybrid
They are, yeah.
between debt and equity.
Yep.
Can you explain how those work?
So convertible bonds offer investors the best of both worlds.
Okay.
They provide the fixed income stream of a traditional bond,
Okay.
but with the added benefit of being able to convert the bond into shares of the company's stock
Okay.
under certain conditions.
So it's like having a bond with a built-in option
Right.
to become a stockholder. If
Right.
if the company's stock price goes up,
Right.
sounds pretty appealing.
You can be, yeah.
What factors determine when and how a bond can be converted?
So each convertible bond has a conversion ratio.
Which specifies how many shares of stock an investor receives for each bond they hold.
Okay.
There's also a conversion price,
Right.
which is the effective price at which the bondholder can buy the stock.
So if the company's stock price soars
Yeah.
above the conversion price,
Right.
the bondholder is in a great position.
They are.
They can convert their bond into shares and capitalize on the stock's appreciation.
That's right. And if the stock price languishes,
Yeah.
the bondholder still has the security of the bond's interest payments
Right.
and principal repayment at maturity.
It's a way to manage risk
Yeah.
while participating in the company's potential upside.
Exactly.
Convertible bonds sound like a sophisticated tool
Yeah.
for investors who are comfortable with a bit more complexity.
Right.
The book also mentions preferred stock,
Yeah.
which seems to get less attention, I think, than common stock.
It does, yeah.
What are the key characteristics of preferred stock?
Okay. And how does it fit into the overall picture?
So preferred stock is an interesting instrument.
Yeah.
Like common stock, it represents ownership in a company.
Yeah.
But preferred stock typically pays a fixed dividend,
Okay.
similar to a bond,
Okay.
and often doesn't come with voting rights.
So it's like a hybrid between a bond and common stock.
Yeah, you could say that.
It offers a steady income stream,
Right.
but without the same potential
Yeah.
for price appreciation as common stock.
Guaranteed.
Who might be attracted to preferred stock as an investment?
So preferred stock can be appealing to investors seeking a predictable income stream
Okay.
with a bit more security than common stock.
Okay.
Since preferred stockholders have a higher claim on assets than common stockholders in the event of liquidation,
Right.
it can be seen as a less risky option.
Okay.
However, it's important to remember that preferred stock dividends are not guaranteed,
Mm-hmm.
and the value of preferred shares can still fluctuate in the market.
It sounds like there's a whole spectrum
Yeah.
of investment options out there,
Here it
each
is.
with its own, risk-reward profile.
Absolutely.
Now, shifting gears a bit,
Okay.
the book emphasizes that cash flow is the lifeblood of any business.
It is, yeah.
What exactly is cash flow?
So cash flow is the movement of cash in and out of a company.
Okay.
It's a measure of the company's ability to generate cash from its operations
Okay.
and use that cash to invest in growth, pay down debt, and reward shareholders.
Mm-hmm.
While net income, which is reported on the income statement, is an important accounting measure.
Okay.
It doesn't always reflect the actual cash a company has on hand.
So it's not just about making a profit on paper.
Right.
It's about having the actual cash
It's about the cash, yeah.
to run the business
Yeah.
and make strategic decisions.
Exactly.
Can you give me an example
Sure.
of how net income and cash flow might differ?
Let's say JMC sells a large order of mouse traps to a retailer on credit. The revenue from that sale is recorded on the income statement.
Mm-hmm.
But JMC doesn't actually receive the cash until the retailer pays its invoice.
Okay.
So JMC might show a profit on paper,
Right.
but they might not have the cash on hand to cover their expenses if the retailer delays payment.
Ah, that's a good example.
Yeah, it's an important distinction.
It highlights why cash flow is so crucial for a company's, short-term and long-term health.
Absolutely.
The book breaks down cash flow into 3 categories.
Yes.
Can you walk us through those?
Of course. The first category is cash flow from operations,
Okay.
which encompasses the cash generated from a company's core business activities,
Okay.
such as making and selling products or providing services.
Okay.
This is the most important source of cash for a healthy business.
So for JMC, that would be the cash they receive from selling mousetraps,
Right.
minus the cash they spend on materials, labor, and other operating expenses.
Exactly.
What about the other categories?
So the second category is cash flow from investing activities,
Okay.
which involves the buying and selling of long-term assets,
Okay.
like property, plant, and equipment.
Okay.
For JMC, this might include purchasing new machinery to expand their production capacity
Mm-hmm.
or investing in a new warehouse.
And the third category.
The final category is cash flow from financing activities,
Okay.
which includes activities related to raising and repaying capital.
Okay.
This encompasses issuing or repurchasing stock, taking out or paying down loans, and paying dividends to shareholders.
So it's a comprehensive view
It is.
of how cash is flowing in and out of the business.
Yeah, it gives you the full picture.
From all these different sources.
Yeah.
What are some key things that investors should look for
Okay.
when analyzing a company's cash flow statement?
One important metric is free cash flow,
Okay.
which is the cash flow from operations minus capital expenditures.
Yeah.
It represents the cash a company's left over
Okay.
after investing in its core business.
Right.
Strong free cash flow gives companies more flexibility to pay down debt, increase dividends, buy back stock, or pursue strategic acquisitions.
Free cash flow sounds like a powerful indicator
Yeah.
of a company's financial strength
Absolutely.
and its ability to create value for shareholders.
It's a key metric.
Speaking of creating value,
Yeah.
the book gets into some of the nuances of inventory accounting
Okay.
and how different methods can impact a company's reported earnings.
Right.
Can you shed some light on this?
So inventory accounting can seem like a dry topic,
Sure.
but it can actually have a significant impact on a company's financial performance.
Okay.
Different inventory valuation methods, such as FIFO, first in, first out, LIFO, last in, first out, and weighted average,
Okay.
can lead to different reported earnings,
Okay.
especially in periods of fluctuating prices.
So the way a company accounts for its inventory
Yeah.
can influence the numbers they report to investors.
It can, yeah. It's an important consideration.
Yeah. Can you give us an example of how this might play out in the
Yeah.
real world?
Let's imagine JMC buys a batch of metal for their mousetraps at $10 per unit.
Okay.
Then a few months later, they buy another batch at $12 per unit due to rising prices.
Okay.
If they use the FIFO method,
Okay.
which assumes they sell the oldest inventory first,
Mm-hmm.
their cost of goods sold would be lower,
Okay.
leading to higher reported profits.
Okay.
However, if they use the LIFO method,
Mm-hmm.
which assumes they sell the newest inventory first,
Okay.
their cost of goods sold would be higher,
Okay.
resulting in lower reported profits.
It's fascinating how these seemingly small accounting choices
know, right?
can have a ripple effect on a company's financial statements.
They can, yeah.
And speaking of earnings,
Yeah.
the book delves into the world of earnings estimates,
Oh.
those predictions that Wall Street analysts make about
Right.
a company's future profitability.
Yep.
How do earnings estimates impact the stock market?
So earnings estimates are closely watched by investors
Okay.
because they provide a glimpse into a company's expected performance.
Okay.
Analysts use a variety of factors, including industry trends, economic conditions, and company-specific information to project future earnings.
Mm-hmm.
These estimates set expectations in the market.
Okay.
And when a company's actual earnings beat or miss those estimates,
Mm-hmm.
it can trigger significant stock price movements.
So if JMC exceeds earnings expectations,
Yeah.
investors might rush to buy their stock,
Exactly.
driving up the price.
Right.
But if they fall short,
Yeah.
investors might sell their shares,
Right.
causing the price to drop.
Great.
It seems like earnings estimates are a key driver
Mhm.
of market sentiment and investor behavior.
Absolutely.
Yeah.
And the book emphasizes that stock prices often reflect investors' expectations about the future,
Okay.
not just the company's past performance.
Okay.
A company with strong earnings today, but a bleak outlook, might see its stock price decline.
Mm.
While a company with lackluster current earnings, but a promising future, might see its stock price rise.
It's a reminder that investing is about looking ahead
It is.
and assessing a company's long-term potential, not just focusing on the present.
Exactly.
Now, before we wrap up, I'd like to revisit the PE ratio,
Okay.
which we discussed earlier.
Right.
The book offers 3 ways to analyze PE ratios. Can you walk us through those?
Absolutely. The first approach is historical PE,
Okay.
which involves examining a company's past PE ratios over time.
Okay.
This can give investors a sense of how the market has typically valued the company
Okay.
in different economic conditions and phases of its growth cycle.
So if JMC has historically traded at a PE of 20,
Right.
but is currently trading at a PE of 30,
Yeah.
it might signal that the market is currently more optimistic
It could.
about its future prospects.
It's a possible interpretation, yeah.
What are the other approaches?
The second approach is relative PE, which involves comparing a company's PE ratio
Hmm.
to that of its peers
Okay.
or to the overall market.
Okay.
This can help identify potential overvaluation or undervaluation.
Okay.
For example, if JMC's PE is significantly higher than that of other mousetrap manufacturers,
Yeah.
it might indicate that its stock is overpriced.
And the third approach.
The final approach is PE based on long-term growth.
Okay.
This method ties a company's PE ratio
Okay.
to its expected future earnings growth.
Mm-hmm.
Companies with higher expected growth rates are often justified in having higher PE ratios.
So if investors believe JMC is poised for rapid expansion
Right.
in the coming years,
Yeah.
they might be willing to pay a higher PE multiple.
Gets the idea.
It seems like understanding these different PE analyses can give investors a more nuanced view of the company's valuation and potential.
Absolutely.
Now, wait, we can't end our deep dive without
Right.
talking about short selling, a strategy that allows investors to profit from a stock's decline.
Right.
It's like the inverse
It is.
of buying a stock.
Yeah.
Can you break down how short selling works
Sure.
and what risks are involved?
So in short selling,
Okay.
an investor borrows shares of a stock they believe will decline in price,
Mm-hmm.
sells those borrowed shares at the current market price,
Okay.
and then hopes to buy them back later at a lower price to return to the lender.
Okay.
The difference between the selling price and the buyback price
Okay.
represents the investor's profit.
So it's a way to bet against a company's stock.
It is.
But short selling sounds incredibly risky.
It can be, yeah.
What happens if the stock goes up instead of down?
That's the catch.
Yeah.
The potential losses in a short sale are theoretically unlimited
Okay.
because there's no cap on how high a stock's price can rise.
Right.
If the stock price climbs significantly,
Yeah.
the short seller has to buy back those shares at a much higher price, leading to substantial losses.
It's a reminder that every investment strategy comes with its own set of risks and rewards.
Absolutely.
Short selling can be a powerful tool,
It can be.
but it's certainly not for the faint of heart.
No, it's not for everyone.
Well, we've covered an incredible amount of ground in this deep dive,
Yeah.
from the foundational building blocks of business
Mm,
to the intricacies of the stock market
yeah.
and advanced financial instruments.
Right.
We've explored the key principles.
Yeah, we've hit a lot of the major concepts.
that drive company value and investor decisions.
It's been a fascinating journey.
Yeah.
And remember, the most successful investors are those who never stop learning,
Mm.
adapting,
Yeah.
and seeking new insights.
It's true. The world of finance is constantly evolving.
It is.
So staying curious and informed is key to navigating its complexities.
Couldn't agree more.
What resonated most with you today? Where will you deep dive next in your quest for financial knowledge?